From New York City for our viewers worldwide, I'm Jonathan Ferro. Bloomberg Real Yield starts right now. Coming up, it's Groundhog Day. Optimism making a return around the same old issues, pushing 10-year Treasury yields above 3-month bills for the first time since July, as the Fed announces it will buy billions of T-bills every month going into 2020. So let's begin with the big issue. It's Groundhog Day for trade talks.
This is Groundhog Day, Groundhog Week, Groundhog Month.
We've seen this before. This ping pong ball going back and forth.
Every few times we make some progress, and then we roll it back.
It's becoming exhausting.
In February of this year, late February, Trump did meet with Chinese officials, and there was a press conference afterwards, and what they agreed to was to have the Chinese buy a little bit more soybeans. And 2 days later, I think it was, Trump declared a truce. In the final analysis, what we know, that never really led to anything.
We've been wrong kind of optimistically the entire time.
They've had a couple years to try to come to compromise.
What we're talking about now is right where we started 18 months ago or so.
A pause is good, a détente, whatever you want to call it. But until I see a rollback of some of the tariffs that went on recently, particularly in September on the consumer, I have to go with sort of our leading indicators, which are still pointed downwards.
Joining me around the table here in New York, Andy Chorlton of Schroder's, Michael Purves of Tallbacken Capital Advisors, and George Bory of Wells Fargo Securities. George, the first question to you. Same issues, same people, same countries. Do we get a different outcome?
In terms of trade, I don't think so. I think trade is sort of in a perpetual state of negotiations. I think we expect that to continue, and we're not expecting a major breakthrough anytime soon. In the financial markets, things seem to be changing a little bit. Yields moving up, and most importantly, the yield curve steepening is actually a material change. It seems like the Fed's rhetoric, the Fed's action is actually starting to sort of meaningfully impact the technicals in the market. And when we think about just sort of fixed income in general, one of the biggest challenges the Fed has faced is an inverted yield curve. The fact that they're actually getting the yield curve to steepen is a meaningful positive, and I think that is something that's very different than what we saw sort of, let's say, just back in the middle of this year when the trade talk and trade issues really became meaningfully problematic and really started to push down yields.
Michael Purves?
You know, it's days like today where I'm sometimes convinced that there's somebody in the basement of the White House who has got an algorithm that fuses Trump's approval ratings, the impeachment narrative with the VIX, credit spreads, and CEO confidence about the economy, and says, okay, now it's time to soften up. And then, but in all seriousness, I do wonder whether, Trump is really effectively trying to sort of collar risk appetite here more broadly right now, right? Where this impeachment narrative goes, is it going to really drive him to get something more definitive and real with China? Because I completely agree that there's not really. Yeah. This is just, come on, we've seen this movie
We saw this
before.
in February. We saw this in February. There was talk of an FX pact. There was talk of buying more soft commodities. They hailed the deal, and then it all exploded several months later, which makes me wonder, Andy, if we don't tackle the big issues, have we really tackled anything at all?
No. This yo-yo doesn't help anybody. You want a concrete certainty for corporate America, for them to be able to feel confident in investing for the future. And that's the big, the noise that we get day to day in the market is somewhat irrelevant. It's the corporate investment that needs to come back, and for that, I think they need certainty.
Well, looking at the market right now, I wonder what is noise and what is signal. My colleague Luke Cower and Tracy Alloway as well, pointing out that we've really had two halves to this week, George. The first half incredibly negative, but we didn't get a big move lower in Treasury yields.
Right.
The second half positive and a big push higher in Treasury yields. What does that tell you about how tough life is down here for a 10-year in and around 150? Yeah,
I mean, the signaling from our perspective is that it's very politically driven, and so you've kind of got tail risk, whether it's trade or maybe we'll talk a little bit about Brexit later on, but some very...
I hope not, but carry on, please.
But these very big sort of overhangs that have been weighing on the market, are dissipating just a bit, and whether or not they get better, maybe it's sort of an indication that they're not going to get any worse, and maybe there's sort of a cap on how far we've gone with respect to sort of trade tension. And so this may be an extended period of negotiation. That seems to have overshadowed the data. The data came in pretty weak last week and this week, and that got people very anxious. But then the Fed is now kind of riding to the rescue. Liquidity solves all problems in today's markets, and so this extra dose of liquidity, this sort of term repo agreements, and sort of the new non-QE QE is it's certainly helping risk appetite. And I think about it in very selfish fixed income terms. You know, there is sort of a liquidity squeeze that's been building up for a variety of reasons. And the Fed is stepping in to basically unclog that squeeze. That in and of itself is a positive.
There has been some debate as to whether it's QE or not QE. For me, what matters, what are they doing, what's the objective, what are they buying, and what are the consequences? We found out today that they're going to be buying up to $60 billion of T-bills, pretty much every month going into 2020. It might be higher, it might be lower. What does that mean for you? Because what we have seen with the Treasury curve, 3-month bill versus the 10-year, finally a little bit of steepness, a positive spread. Do you expect that to continue?
We do expect the curve to continue to steepen. And I think what it signals, and as I mentioned before, you know, there's a sort of a liquidity squeeze buildup kind of that's been mounting over the last several weeks as we headed into the end of the quarter. You saw it in the repo market. You're sort of hearing about it in different parts of the fixed income world. I think that's a function of kind of a flat to inverted yield curve, kind of the structure of excess reserves. There's a variety of things. But the Fed is focused on breaking that logjam. And in doing so, that releases a lot of tension in the market. And I think that's a positive going into year end.
Michael Purves?
I think just another facet of this whole discussion about the torque that's been sort of built up in this markets, this squeeze potential also gets back to the Eurozone and China to some degree. You know, if you measure the spread between the EM equity ETF, that volatility metric relative to the VIX, that's at year-to-date lows right now, right? And you look at some of the economic data coming out of the Eurozone, it's certainly not getting sustainably obviously better, but it's seeming to bottom. So, you know, play a scenario out here where these Bund yields are going to, you know, if they do march back to zero, that's going to re-steepen our curves over here pretty sharply.
Andy?
Yeah, I think you need to bear in mind that the Fed's operation at the front end, you could almost see it as a reverse operation twist. They were getting sick and tired of this self-fulfilling prophecy of an inverted yield curve. How many times has it been discussed on this show? By buying all those short-end paper, by providing liquidity that George referred to, suddenly the curve steepens. Those models that tell everyone recession's around the corner, no one's talking about it anymore. So you've got to be careful. There's some smart strategy going on.
That's helping the 3-month to 10-year. Let's talk about the rest of the yield curve. This is shaping perceptions over what the Fed will and won't do at the end of this month. If these trade talks go well, and for anyone watching this over the weekend, we are recording this ahead of the conclusion of these trade talks. So if these guys get it wrong, you can throw mud at them on Monday. But we don't know the outcome just yet. But George, looking at that situation right now, it's interesting to me that when I speak to economists and ask them the following question, if it's a truce, but the tariffs don't come off, what does it mean for the economy? They turn around to me and say not a whole lot. But the market participants admit that we'll get a short-term squeeze in the market, which makes me wonder, if the market is reassessing the chances that the Fed moves at the end of the month based on what happens with this trade talks, aren't we basically also making the judgment that this Fed is managing the markets and not the economy?
I think they've had to walk a pretty tight line in the sense that they have, up until very recently, not really talked a lot about the technicalities of what an inverted yield curve does to their funding and their operations. And there are some economic consequences, but there are a lot of financial front-end consequences, and they've finally started to dial in on that. Their view that this is sort of a mid-cycle adjustment would suggest that that's really more their economic view, that they're not intending for this to be a sustained rate cutting cycle. Now they've left the window open if the data continues to deteriorate. But if they are able to sort of cut rate one more time, steepen the curve, and allow sort of the markets to adjust, they could be on hold for a little while after the end of this month. That's our central view, that they don't do anything till at maybe the next quarter, that they're on hold till through the end of the year, as the rate structure sort of stabilizes and then these liquidity provisions start to kick in.
Michael Purves?
I think there's another dimension to the Fed's calculus, which they can't really talk about, but I guess I can, which is that as we're looking into the election year, if they do start cutting aggressively, and then let's say, you know, a lot of the economic data, the trade war comes to a defined resolution sometime early next year, things are better overseas, and inflation is starting to stoke back up, then they're faced with having to raise, perhaps, into November 2020, which is typically the Fed isn't fond of doing, right? And you can only imagine the amount of tweets that will be coming out of Europe. I know someone else that might not be fond of that idea as well, Michael. What's your take, Andy?
I think the market's going to bully them they have to move in October. I don't think anything substantial is going to come out of the trade talks that's going to change that direction. We've talked about it before, the way that the Fed has a third leg of their mandate, which is to continue the expansion, which is measured by what we see on our Bloomberg screens every morning. And I think that piece means that they definitely do the 25 and then maybe on hold, because they still want to keep some dry powder in the event that it's much worse than any of us think.
Guys, you're going to be sticking with me around a table here in New York City. Coming up on the programme, leveraged loan borrowers planning ahead as the index falls to a fresh 9-month low. That conversation is coming up next. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. I'd like to head to the auction block now and begin over in Europe, where Greece became a member of the region's negative yield club. The country selling 487 million euros of 13-week bills, drawing a yield of minus 0.02%. In the United States, the government's $16 billion auction of 30-year bonds was awarded a yield of 2.17%, the lowest 30-year auction stop on record. And in leverage loans, 8 deals launching for a total of $8 billion this week, despite several cracks appearing in the market as the index fell to a fresh 9-month low. The recent shift in sentiment leading investors to flee some of the shakier issues. Eaton Vance's Andrew Sveen running to note the following. People want the well-performing loans and are more wary of taking chances on the situations that have turned negative. With me around the table to weigh in, Andy Chorlton, Michael Purves, George Bory. George, I want to begin with you. What is happening with loans right now? Is it anything more than just saying, you know what, leverage loans, I don't want floating rate right now. Rates are going one way, they're going lower. Is there anything more than that?
There's more than a rate story. I mean, there's a component of it, but there are some signs of stress within the leverage loan market, and that's sort of the headline bad news. The underlying story is it tends to be concentrated in specific sectors and very specific vintages of when these loans were originated. Late 17, early 18, energy-related notes, maybe some retail-related notes. These were sort of cuspy credits when the loans were made. And then that loan, that company, if they miss on earnings, those bonds go from 90 to 60 in a flash. And it's the reality of how, what the quality of the underwriting was back, sort of a year or so, 2 years ago. And that's what's starting to bubble through. Now, a lot of the challenge is that there were a lot of loans that were originated then, and so it's a relatively sizable group of companies. And so you take some weakness in the energy sector, some consumer-related weakness on a bad vintage in a big series, and it looks bad. And there are some challenges, but it's not as systemic as people think.
You mentioned 2017 and 2018, and I think it's important for our viewers out there that maybe aren't too familiar with the fixed income market. This might sound counterintuitive, but it was when rates are going up that some of the bad issues really came to market, and it was in leverage loans because people wanted floating rate. Rates were going higher at the Federal Reserve.
That's exactly right.
And that's what I want to talk to you about.
Yeah.
That specific pocket, the amount of debt that came to market, possibly placed too richly and with very little covenants around them. Is this a problem that's brewing now? Are we starting to see this materialize?
Well, you are. I mean, if you look at, say, the downgrade to upgrade ratio, downgrades are within, say, single B and below loans. So these are the riskier parts of the loan market. You have an upgrade downgrade ratio of 3 to 1. Sorry, downgrade to upgrade ratio. So there's some fundamental weaknesses that are emerging in this sort of basket of companies. But the market's very, very, what we would call bifurcated or segmented. If you just sort of go up in quality or away from that particular vintage of issues, prices are holding pretty steady, the companies are functioning, those loan covenant packages are a little bit stronger. There are sort of places to go, within the loan market, and loans are inherently illiquid, so migrating your way into those positions, it's not an easy trade. And we talked about repo and liquidity in the broad market. You try and do that in an illiquid market, and it all gets accentuated.
Andy Chorlton?
I think you mentioned the demand for the asset class back in 2017. When you get an excess of money chasing finite opportunities, quality is compromised. And I think the one thing you can take from what's happening in Europe at the moment, where we've had low negative rates for a long, long time, it doesn't excuse bad companies with bad balance sheets. So not bad companies, sorry, it's the bad balance sheets, not the bad companies.
Right.
And I think that's the thing that's going to come to bear. And when the quality is compromised because of that technical mismatch, problems are going to arise.
We're starting to see those cracks right now. I guess to take this one step further, George, whether we're seeing this problem just in leveraged loans or more consistently across the fixed income universe.
Yeah.
Are you seeing it bleed across?
You are. I mean, if you look at, say, triple C's in high yield, you'll see some pressure. There are a lot of stressed energy companies that specifically sit in the triple C universe. Also in the CLO market, again, there's that segmentation. The lower rated parts of the CLO market have come under pressure, but also, there are different qualities of managers. So the managers that maybe just launched at that particular point in time when those loans were being originated hold pools of loans that are, basically experiencing more risk, more challenges than others. So it manifests itself. The loan market is pretty broad, very deep, and kind of spans across, a wide range of industries, companies, and managers. And you can sort of see where the weak spots are. And I think that's kind of what's coming through right now.
What's interesting at the moment, Michael, is at the index level across a whole range of asset classes, you don't really identify too many problems until you lift up the lid, have a poke around, and once you've had a look, you start to see some cracks and some nerves.
Yeah, and I think that's part of this divergence story from the very lower quality, this huge escalation in issuance in leveraged loans coupled with weakening standards. If the economy is going to be in 2020 and beyond sort of what the equity market and broadly speaking the high yield market are sort of saying, it's going to be maybe a 2% growth, 2% inflation environment, more of what we've seen, then probably the damage is going to be pretty minimal. But if the Treasury market is right, if you will, right, and it had been telling us, maybe not today, but it had been telling us that it's more like a 1.25% story next year, with a higher chance of some sort of recession, then that's when you really need to be in the higher quality stuff. And I think that's why this divergence is going to be continuing, because we just simply don't. No one knows, whether the equity and credit markets are right broadly about 2020 or whether the Treasury market is telling us something that we don't know.
What's the market call, George?
Well, when you look under the hood, the market call for us is that, do you want to own one single B loan at LIBOR plus 450, or do I want to own a triple B tranche of CLOs at LIBOR plus 400? Where you have diversity, you have a much broader range. And so, the market call for us is that, there's the up in quality bias is likely to persist as this shakes out, but the value argument across the market is starting to emerge. The advancement, the one nice thing about rating cycles is that you do ultimately work through them. We're in the eye of the storm right now, especially going into year end when liquidity is thin. Being a liquidity provider at a point in time where, quality is somewhat compromised, that's the value trade.
Guys, really smart stuff. You're going to be sticking with me. Still ahead, the final spread, the week ahead, featuring EU leaders gathering for a 2-day summit in Brussels. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. Coming up over the next week, we get some data out of China, trade numbers going through to Monday. Then on Tuesday, additional tariffs on Chinese imports are set to take effect, plus US bank earnings kicking off. Wednesday, the IMF and World Bank meetings begin in Washington. And finally, on Thursday, EU leaders meeting in Brussels for a 2-day summit. Andy Chorlton, Michael Purves, George Bory still with me. I promised you that we probably wouldn't talk about Brexit, so I'll try and avoid it just for a little while. We'll get to that in just a moment. But your thoughts on the trade story and the global economy at the moment. A little bit more data out of China. We've had it in the last couple of weeks. We get some more in the next couple of weeks as well. People are trying to understand, George, to what degree the trade story is responsible for the global economic slowdown, given the fact that the slowdown started and predates the actual tariff hikes.
Right.
How do you get your head around that issue at the moment?
Right. I mean, like you said, trade's been slowing for a few years now. And I think the rhetoric and the emphasis on it has been accelerated by Trump and by the discussions around it. How do we get our head around it is really trying to figure out sort of for the U.S. economy specifically, how vulnerable it is to further deterioration of trade, and sort of what's the negative feedback loop. And so what we've seen is, obviously it's impacting the industrial manufacturing side of the economy. There's a two-speed economy in the U.S. Industrial manufacturing, very weak. The consumers doing pretty well. If this starts to affect consumer sentiment, it becomes problematic. It hasn't really fully dented or meaningfully dented consumer sentiment, and so we've been able to trundle along, but lately you're starting to see some signs of that. That would be number one. Number two, the Fed has moved, and the drop in yields and the very meaningful loosening in monetary conditions here and in Europe, it will help. It may not help as much as it would have 3 or 4 rate cuts ago and cycles ago, so it becomes less potent, but it will help. And there's a 6 to 12 month lag. So our expectations is by the time you get to the end of this year, what we're seeing is a deceleration. I call it, it's slowing but growing. And you start to see that you're seeing the slow, but then you start to bottom out, and it's really into the beginning of next year that growth starts to pick up again.
Just quickly, Andy.
Outside of the Fed, I think developed market central banks have basically reached the limit of their effectiveness. And so with an absence of any fiscal response, the trade issue is just that constant negative kind of underlying feature. So until that gets truly resolved, which I think means closer to the election here, we're going to have this kind of low enthusiasm in the market and in the economy, because we need fiscal in Europe, and if we haven't got that, we need trade sorted here.
Well, there's a bit of enthusiasm to close out this week. Let's close out this show with a rapid-fire round, shall we? 3 quick questions, 3 quick answers if we can. Brexit. This is the only part of the programme we will do Brexit. Brexit, deal or no deal before month end? Deal or no deal before month end? George?
No deal.
Michael?
No deal.
Andy?
Deal.
Do you buy a trade truce or do you sell the risk rally? Do you buy a trade truce or sell the risk rally? Michael?
You sell the risk rally, not as much as you might have 6 months ago.
Got to be short, Michael. Andy?
Sell it.
George?
Sell.
Third and final question. The Fed cuts through 2019. 1 more, 2 more, or none? 1, 2, or none? Michael?
1.
George?
1.
Andy?
1.
Guys, great to have you with me. Andy Chorlton, Michael Purves, George Bory, thank you very much. From New York City, we'll be back same time, same place. This was Bloomberg Real Yield. This is Bloomberg TV.